Conventional banking wisdom says, look, if I'm dealing with debt, whether that be mortgage debt or whether that be unsecured debt or secured debt, debt of any kind, there's only a certain number of ways that I can pay that debt down quicker, save myself time, and save myself money. One of those methods in conventional banking is to refinance to a lower interest rate. Secondarily would be to apply more money to principal. And third would be to do a debt consolidation. But many times we lack either the resources or the know how in order to navigate this and be able to accomplish this. Thirdly is the discipline piece of applying that additional money regularly. The Money Merge Account program would like to show consumers how to facilitate an accelerated payoff and eliminate thousands of dollars in debt with little to no alteration to one's current standard of living, with no refinancing of the first mortgage necessary, and with no consolidation necessary. Now, we do find that many of our clients that will get on board with United First Financial and the Money Merge account will seek the advice of brokers that they know or lenders or people in the industry, and they will go forward and do a refinance. Or they may go forward and do a consolidation, but we want to make it very clear that it is not necessary for the Money Merge account program to do any refinancing of the primary mortgage or consolidation. What the Money Merge account does for clients is says, what do you have today? And if this is what you have today and this is what you're doing today, let's show you what we can do for you tomorrow. There are four basic strategies or core principles that drive the Money Merge account program that I would like to go into depth and explain how these integrate in order to create the dynamic power of the Money Merge account program. The first is the concept of interest cancellation. Second is strategic payoff. Three is time value of money. And number four is the Money Merge account software, coaching, and education system. Let's dive right in to strategy number one, interest cancellation. In order to view this, I want to view a mortgage because I think most people can look at a mortgage and really see how much money we have to pay back on a mortgage, how much debt we are truly in. It's typically one of the largest debts that most consumers face. We're going to start with a mortgage of a $200,000 principal loan amount, and we're going to say that's at 6% interest. Now, if this was a 30-year loan, I would have a monthly payment of $1,199.10. Now, I just want to bring the 10 cents up so you know that it's there, but I want to stay in very round numbers because the main thing I want to do is get the concept across to you. If this was the situation, if we made every single payment for 360 months, we'd pay back $431,677. That means we borrowed $200,000 on principal loan amount. We're going to pay back $231,677 in total interest paid. But let's go a step further. Let's look at an amortization schedule that represents this loan. And we're going to use our sample client or our represented client, John and Rebecca Jones. And John and Rebecca Jones have that $200,000 mortgage at 6% interest with the monthly payment of $1,199.10. If they make their first payment, $199.10 will go to principal, $1,000 will go to interest. Let's move to month two and see what happens. If they make their payment in month two, their principal contribution increases by $1. They go from $199.10 to $200.10. At this point, I'd like to draw your attention to the columns that say equity and paid. And let's see what this looks like 1 year out. Provided that the client's home, John and Rebecca Jones, is still worth $200,000 at the end of 1 year, then what we see is they've paid in $14,000 and their potential equity position is about $2,400. In year 5, they've paid in $71,000, potential equity is about $13,000. In year 10, they've paid in $143,000 and the potential equity position is only $32,000. Here's the one I love. 21 years. They've paid in $300,947 and their potential equity position is $99,436, and that's first provided that the home is still worth $200,000. But secondarily, that's provided that the client has not performed a refinance on that property in the 21-year period, which would not be in correlation to the average standard of homeowners. The average homeowner refinances about every 5 to 7 years. I want to take a look at a prepayment example. If we applied additional money to a debt, what that would do to save us time and save us money and create a situation of interest cancellation. If John and Rebecca Jones make their first payment in the amount of $1,199, and then they apply $5,000 of their own money, we can call this savings or mattress money. It really doesn't matter at this point where it came from, but they're going to make that first payment in the amount of $6,199. Now, what we do know is that they did not recontract the loan with the lender. They still have the same loan structure, but what they have done is they have reduced the balance by $5,000. So their new principal loan balance starting out is $195,000. If they were at 6% interest, have a monthly payment of $1,199.10. If they applied that money, their 360-month loan would now be reduced to 337 months. What they have done is advance the amortization schedule by 23 months. That's 23 months of payments they will never make back to the lender. That's 23 months of interest they will never pay back. The original configuration said they were going to pay back $231,677 in interest. By applying the $5,000 to principal, they'll now only pay back $203,373 in interest. That's a gross savings of $28,304. Let's back out the $5,000 in original principal amount that they applied, and that would give us interest cancellation or a net savings of $23,304. That's $23,304 of future interest that has now been canceled that John and Rebecca Jones are no longer obligated to pay.